Good morning for those in the UK, in GMT. We are here today with an incredible panel. We're going to be discussing a very new report by Carbon Tracker that focuses on a very important topic. What is the future of the UK power market? What will be the best design that would guarantee a low cost of electricity in a low carbon future? We have a lot to cover, so I'm going to hand over to the panelists and they will introduce themselves, and then we will have a presentation. If you have questions, please do share them with us. We already have received a few questions that we will start with those, but hopefully we will have time to address all the questions we will get from the audience. But if we do not have time, the team at Carbon Tracker will make sure to address the questions that we'll be receiving today of all of you. So my name is Gabriela Herculano. I'm CEO and co-founder of Green FinTech iClimate Earth. We focus on the companies that are leading the energy transition. It's a huge pleasure to be here with you today. This topic of how to guarantee a low-cost, decarbonized grid is of great interest to all of us. So without further ado, I will hand over to Jonathan, and each panelist will introduce themselves, and then we will get a presentation and then conclude with the Q&A. Jonathan.
Thanks, Gabriela. Hi, good morning to everyone. I'm Jonathan Sims, one of the senior analysts on the Power and Utilities team at Carbon Tracker Initiative. We are a financial think tank producing analysis on the impacts of the energy transition from fossil fuels to low carbon technologies on capital markets. I've been with the organisation for just under 2 years, having spent the previous 8 working on power and carbon trading analysis in the business intelligence sector.
I'll jump in next, yeah. Well, thanks again to everyone who's joined us this morning to discuss the report. My name's Sam Clissold. I joined Carbon Tracker mid last year as an associate analyst in the Power Utilities team and worked on the modelling for this report. Prior to joining Carbon Tracker, I spent 3 years in finance on the sell side doing equity research.
Thank you, Rob.
Morning all, great to be on this panel today. I'm Rob Mangan. I'm a policy lead in the review of electricity market arrangements at BEIS, Department of Business, Energy and Industrial Strategy. The review was launched last year looking at a wide array of potential reforms to future electricity markets, and I'm sure we'll kind of dig into the detail of some of those later in the discussions.
Thank you. Christian?
Good morning, everyone. My name is Christian Redl. I'm with Agora Energiewende, a Berlin and Brussels-based energy policy think tank where I work on projects related to power market design, renewables policies, and energy system scenarios. So thanks for Carbon Tracker for inviting me. Looking forward to the input and the discussion. Thank you.
Last but not least, Ben.
Hi, good morning. I'm Ben Shafran. I had the policy team at Energy Systems Catapult, which was set up by the UK government to support innovation towards net zero and to ensure that the UK economy captures the benefits of the energy transition. Thank you.
It's a fantastic panel. We have a lot to cover. The topic is technical. We will start with a presentation that summarizes this brand new report. Jonathan, I believe you have the slides. Perfect.
Thank you. Yes, so following the publication of our latest report, Marginal Call, just yesterday, focused on Britain's options for future power market design. Sam and I are this morning going to take everyone through the modelling work we did for this project and summarise our results and conclusions into the best option for policymakers to pursue in this area. Next slide, please. So we believe that there are 3 options put forward by government last year that are the most feasible for long-term power market design. The first being a continuation of marginal pricing, but altering mechanisms around it to maintain strong investment signals for future renewables and to protect against future gas price spikes and their influence on the power market. The second being a shift to a locational market pricing design in either a nodal or zonal form, which is something I'm sure will be covered and discussed in greater detail during the panel discussion. But the final third proposal listed here is one which particularly interested us, as we believed it was probably the most far-reaching of potential reforms put forward. And this is a splitting of the power market, which would see variable renewables, so wind and solar, priced separately to that of dispatchable technologies, to allow for greater influence on price formation from those inframarginal sources. We thus chose to focus the modelling work for this project around the application of such a market split on both recent years past and for future years, out until the UK's deadline for completing power sector decarbonisation in 2035. And I'm going to hand straight over to Sam to take you through how we approach the modelling for this.
Thanks, Jonathan. So to model the implications of marginal pricing versus a potential market split on the costs of power in the wholesale market, we built an in-house model that extrapolates the 2021 generation and load profile of the UK grid outwards to 2035, scaling up renewable generation based on the expected capacity additions that will be needed to decarbonise the power sector in line with the UK government's targets. And so to illustrate, the chart on the screen shows the results of our model for a random 24-hour period in 2023 on the left-hand side, and then that same period in 2035 on the right-hand side. The yellow line at the top of the curves is total power demand on each of these days, and the area under the curves show the composition of the power generation mix, with green representing renewables and the grey shades being dispatchable fuels such as coal and gas. And then finally, the blue line is an estimate of what the wholesale power price would be under marginal pricing. And so beginning with the 2023 example, you can see that renewable generation was insufficient to satisfy demand at any point during the day. However, by 2035, renewable generation will in fact be able to meet demand for prolonged periods, and this shift has important implications for the behaviour of the spot price. In a marginally priced market, the wholesale price is by design the variable cost of the power source that's at the equilibrium between supply and demand. And so in other words, the variable cost of the power source, which is touching the yellow line at the top of the curves. And so in the 2023 example, dispatchable fuels were meeting demand and setting the marginal price throughout the entire day. However, by 2035, renewables, which have much lower variable costs relative to dispatchable generators, are meeting demand, meaning that the marginal price is very low and stable, before rising dramatically in the evening when dispatchable generators are called upon by the grid. And so just before moving on to how this situation would play out in a market split, I'll give a quick overview of the core differences in how we modelled power pricing in these two trading arrangements. And so firstly, in this schematic, the blue blocks represent generation from renewables, the orange blocks generation from inframarginal dispatchable generators such as nuclear and biomass. And then the green blocks represent the dispatchable power source that's meeting total demand, which in the UK is typically gas. And so to recap, on the left-hand side, in a marginal market, the variable cost of the generator at total demand, which is gas, sets the market clearing price, and every other participant in the market gets paid that price for the power that they sell. Moving on to a split market on the right-hand side, we assume that the power market would be separated into two segments with different pricing rules. On the one hand, there'd be a dispatchable segment where fuels like gas are priced in the same way as they are today. And on the other hand, a renewable segment with wind and solar priced at their total costs, so the sum of both their fixed and variable costs. In this case, the cost of wholesale power in a split market would effectively be a weighted average between renewable generation priced at total costs and dispatchable generation priced at variable costs. And so returning to the example we had earlier, this is the same chart, but just with the split market price plotted in red. You can see in both of these years, there's a difference between the marginal and the split price. However, the difference grows much larger by 2035. And this is mainly because of the significantly higher intraday variation of renewables versus dispatchable generation in the grid. When renewable generation is very high, or even at 100% of demand, pricing in a market split effectively places a floor on the power price, preventing it from falling as low as it would in a marginal market. And this is because 100% of demand is coming from the renewable segment, where generators are selling at total costs rather than variable costs. However, in the evening, when the renewable generation drops off and there's more influence on the price from the dispatchable segment, the situation inverts and the renewable segment of the market begins acting as an anchor on the spot price, preventing it from rising as high as it would if dispatchable fuels were the only price setters. And so it's been assessing the extent of these discounts and premiums between the split price and the marginal price, as well as how these differences could impact the overall cost of power in the wholesale market, which formed the basis of our modelling for the report. And as for the results, beginning with a historical analysis, we found that splitting the market in 2020 could have resulted in significant cumulative savings on power expenditures compared to marginal pricing up until the end of 2022. However, you can see that from the chart, initially the savings line is actually sloping downwards, and therefore power expenditures would have been higher under a market split. And this is because from the start of 2020 until the middle of 2021, the UK gas price was relatively low and stable. However, beginning in the second half of 2021, gas prices began to rise dramatically, and the savings line begins to slope upwards because under a market split, the presence of renewables would have worked to decouple the strong relationship between the price of gas and the price of power, preventing the wholesale power price from rising to the extreme levels we saw last year. And importantly, because the rally in gas prices was sustained, this would have been sufficient to flip the savings figure positive, translating into cumulative gross savings of around £6 billion, which is the green area on the right. So looking outwards to 2035, we see a similar picture in terms of a market split only being cost beneficial if gas prices remain significantly elevated relative to historical levels. Due to the uncertainty around future gas prices, we ran 4 scenarios, and you can see from the chart that only under our highest gas price scenario, which is the red dotted line, where gas consistently trades at around 3 times historical levels, would a market split deliver cumulative savings relative to marginal pricing. And so this, taken together with our view that in the long term, gas demand and therefore prices will decline owing to increased competition from renewables, we expect that on balance, it's in fact marginal pricing that will deliver the best long-term value to consumers from a cost perspective as the UK decarbonises the power grid. And so that's an overview of the modelling approach and our main findings. A full description is available in the appendix of the report, and happy to answer any questions on the methodology in the Q&A. But with that, I'll hand back over to Jonathan.
Thanks, Sam. So just to summarise then, our conclusions from this modelling are that a market split design would only deliver cost savings over the longer term for Great Britain if global gas prices endure a sustained period of high prices, and that consequently we recommend the continuation of marginal pricing given the associated risks of revenue uncertainty for investors which could be created under reforms which appear to offer no guaranteed economic benefit. Next slide, please. Our results have, however, shown the extent to which the global gas market can skew GB power prices beyond levels that are reflective of the actual operating costs of the modern generation mix. And we therefore believe that policymakers should introduce measures which protect a power market continuing to operate under marginal pricing from gas market influence until the point where this is naturally removed through the completed decarbonisation of the system. And this could include imposing hedging obligations on utilities for their future fuel needs, which would at least provide long-term price stability for consumers and protection from gas-led price spikes on the spot market. We also believe that reforms to the CFD support scheme for low carbon generators can help it to continue to ensure long-term investor confidence in the British renewable sector, but call for that mechanism to be firmed up. We welcome that the recent CFD consultation includes plans to prevent contracted generators from delaying the uptake of their CFD until several years after first operation. But we would urge that a rule which stipulates that CFDs do not pay out during periods of zero or negative power prices is reviewed. Instances such as these will increase significantly over time as renewables gain greater market share. And while we understand this is important to prevent oversupply, the risk to project revenues that this could create could deter investors from participating in the scheme. And a shift, therefore, to a more revenue-focused model which takes account of generators' combined revenue streams rather than solely the wholesale market price, could thus protect against this risk and ensure that we continue to see a sufficient levels of renewables deployment coming forward to deliver that key 2035 target. Thank you very much for listening, and we look forward to the panel discussion.
Thank you, Jonathan, for the presentation. We already have quite a few questions, but I'll start with a high-level one. What would be the best way to give investors into renewables confidence in the mechanism, in the way that they will get their return on their invested capital, having that 2035 full UK power sector decarbonisation target in mind?
So I can start with that. I mean, we think that the CFD scheme has been highly successful in delivering sufficient levels of renewables to come forward since its introduction. And we just think that mechanism needs to be firmed up, as I said, around a future structure operating on marginal pricing. And the idea we sort of put forward on revenue restructuring is an idea that is referenced in the REMA document as a way future support payments for low carbon infrastructure could be based. And this would be a kind of revenue cap and floor scheme, building on the success of a similar mechanism that has been in place for interconnector investment in the UK. And so this would take greater consideration of a generator's overall revenue stream. So not only those coming from the wholesale market, but also the capacity market, balancing market, ancillary services. And so sort of revenue cap and floors would be determined prior to a project's commissioning, and top-up payments would be made if overall revenues for a given year fail to reach pre-agreed floor level, or the generator pays back anything that exceeds the cap. And that suggestion is based on concerns over whether the rules stipulating that the CFD contracts do not pay out if market prices slump to zero or below, which, given the likely increased occurrence of this over time in a renewables dominant system, could begin to deter investor confidence in the scheme. We understand why that rule is there, but rather than changing it, wonder whether the support scheme could be adjusted to reflect the fact that generators will source revenues from a variety of platforms in future years.
Thank you. Rob, Christian, and Ben, would you like to add to that?
Maybe, sorry, Rob, please go ahead.
Yeah, I mean, I guess just to come in from the review of electricity market arrangements perspective. So obviously we launched our consultation last year, and really it was quite a kind of a wide-ranging consultation with a wide array of kind of different arrangements on the table. And we completely recognise that the contracts for difference, which was introduced about 10 years ago as part of the kind of initial phase of electricity market reform, has been enormously successful in terms of bringing forward investment in renewables, providing investor confidence, etc. But as kind of Jonathan has highlighted, it's not perfect. There might be ways in which it could be kind of improved or changed for kind of future. And so in our consultation, we really laid out a kind of a wide variety of different options. So maybe kind of a CFD with a greater degree of price exposure, so that there's that incentive to respond to marginal pricing in the wholesale market, or as Jonathan alluded to, because there is a potential kind of risk to investors in terms of the curtailment or low prices, whether a scheme that kind of decouples a payment from output, so either a CFD with deemed generation, or a revenue cap and floor might be a more appropriate model. So obviously none of those options is perfect. We had a lot of feedback to the consultation, and we're now at kind of a period of developing, refining, and kind of narrowing down those options for reform. We'll be publishing a response to that consultation in the near future, as well as a further consultation later in this year, where we'll kind of really kind of lay out those options and where we're at. But obviously, you know, nothing is kind of perfect, but the confidence that investors might have in a particular scheme to give reliable revenues is obviously a key consideration going forward, given extremely ambitious targets to build significant amounts of renewable generation, which needs high kind of capital investment in the upfront period.
Maybe if I might add, I mean, I fully agree with what Jonathan and Rob have said. Just wanted to, I mean, maybe as a third element, bring in the CFD as an important tool, of course, to stabilize revenues, minimize risks, and as such also the costs for renewables deployment. There's then the importance that the renewables also can access very short-term markets, ancillary services, etc. And then maybe as a third element, somehow complementing also the CFDs in terms of long-term contracting, also of course the role of corporate PPAs, where I think also some enabling frameworks and strengthening contract standardization, maybe governments taking a role in taking over parts of the counterparty risk. I think this all can help then to really make the huge amount of investments into renewables a reality that we actually need in the UK, but also throughout Europe, of course, to get to 2035 net zero power systems.
Just to quickly add, following up on the point that Rob made, you know, there's been a message from certain parts of the industry that reforming CFDs or reforming the markets at this time would cause all sorts of undesirable apocalyptic implications for investment in renewables and our ambitions to decarbonize the electricity sector. And I do think it's worth just sort of giving us a quick reminder of history and the electricity markets review. You know, when that took place, the message was that the upside to investment in renewables being capped through CFDs would make the investment a lot less attractive in comparison to renewables obligations, which was the support mechanism at the time. As Rob said, that's not turned out to be the case. If anything, CFDs have been incredibly successful and the industry has adapted itself very well. So I do think it's important that we don't infantilize the investment community. They are very, very good at adapting to market designs and finding opportunities and finding new tools. If you look at how markets in the US have adapted to much more granular price signals, mechanisms have been introduced either within the market design or through external financial hedges that support a level of investment in renewables. Of course, the US has different sort of ambitions or has in the past had different ambitions for decarbonisation compared to Europe, but certainly the investment has existed in those markets, even with quite sharp price signals. So the market and investment community adapt, and I think we should be conscious of that.
Those are excellent points. We're talking about investors and their needs, but we also need to talk about consumers. Can we go further on elaborating on the measures, specific measures that could indeed shield consumers from these excessively high electricity retail prices that we're observing? Jonathan, should we start with you again?
Sure. So I mean, ultimately, the simplest way to bring down energy prices in the long term is to increase the amount of lower cost and lower risk renewables capacity in the system. The huge amounts of energy price volatility that we've seen over the past 18 months or so have been primarily driven by an overdependence and exposure to the global gas market, which has come about because the policies that have driven rapid coal phase out have not been properly aligned with the policies required to accelerate the low carbon capacity required to replace those retiring coal units. But more specifically at the retail level, in terms of ways to cut bills further, I think demand reduction has a key role to play, and I think this is often forgotten about as a crucial tool that can make a significant contribution towards long-term emissions reduction as well. And then on the supply side, for the domestic market, financing mechanisms that take capital expenditure responsibility for rooftop solar, perhaps away from the average house owner, and mean that they won't have to pay entire investment up front, but do see their bills progressively fall, should encourage greater adoption rates, and these can then be extended to low carbon technologies beyond the power sector, such as EVs and heat pumps, if successful.
Just to support the point Jonathan has made, I was going to say, you know, the EMR has been successful at supporting investment in renewables, but one of the outcomes of that has been a sort of imbalanced energy sector where other areas do not receive the same amount of attention or have not been able to grow as quickly, the sort of things that are required to enable the investment or the growth in investment in renewables. So I think it's really important that reform going forward takes a genuine whole system perspective and looks to support investment in renewables and flexibility and longer term demand reduction, all on a like basis. And to that effect, I think it's essential that retail reform moves in lockstep with REMA, with wholesale market reform. It just doesn't make sense to me to go to all the efforts of, you know, essentially relaying all the pipes in your house, but then putting the same old house on top of that back again. We have to think of the two as sort of working jointly and being developed together. So it'll be interesting to see what comes out of BEIS in that regard.
And maybe to complement and add to what Ben said, I think indeed it's very important that, I mean, obviously there is a need for short-term relief and short-term measures to tackle the issue of high retail prices and consumer bills, both for households but also industry. At the same time, we have to keep in mind that we need to move to a fully decarbonized power system within a bit more than 10 years or so. So any short-term reform should not negatively affect, let's say, our options to move to this decarbonized power system. And here, with wind and PV becoming, let's say, the key pillars of our power systems, it's really about, and this is also what the report Sam and Jonathan have presented shows nicely, it relies a lot on marginal pricing, right? We need the price incentives to get the flexibility into the system. With average pricing, we have seen then the spreads between low and high prices would already be lower. So there would be less, let's say, price-based demand response, opportunity to smartly integrate storage, demand-side response into the system. And as such, I think it's really then how to bridge this wholesale market reform with the retail market reform, so to speak. And there, I think the CFDs are a good element because, of course, I mean, it's still possible to integrate renewables system friendly in the wholesale markets with a smart CFD design. And at the same time, governments can raise revenues in terms of high prices, because the whole situation is because we have a fossil gas supply crisis. And this then again would raise the revenues for targeted relief of households and consumers. And I think how this is how the elements come together, but it's really important. Yeah, there is a need to do something short term, but let's not forget what we need to achieve efficiently an outcome also in the long term.
Yeah, I think just to echo Christian's points, obviously there has been this acute period recently of high gas prices leading to potentially high consumer bills. In the UK, we've had the energy price guarantee, which has put limitations on consumer bills to protect there, and the electricity generator levy on kind of potentially excessive inframarginal rents that generators might be making in order to kind of ensure that consumers are protected in the near term. But obviously, we completely agree that we've got these very ambitious targets, a decarbonised power sector by 2035 in Great Britain, subject to security of supply, which we need to do alongside having kind of a system that works and is affordable for consumers. And so I think what we're trying to do through the retail, through the review of electricity market arrangements is really, look at that kind of holistic picture of everything on the kind of the generation, the flexibility side. So, you know, we really recognize in our kind of case for change that it needs to be kind of joined up, that, you know, there's the investment in renewables, but also there are also limited signals for demand reduction for electricity markets at the moment and limited investment signals for flexibility. And so we need to kind of generate a package of reforms which together addresses all of those particular aspects. And while retail markets is kind of outside of our particular scope, we are working extremely closely with the ongoing resale market reform which is going on to make sure that there's a retail market which works consumers, that, you know, consumers can participate in demand side flexibility, so that those who can contribute to flexibility can lower their bills, but also that for those with kind of less flexible demand, the retail market also works for them. So completely agree that, you know, as well as the near term, it's a key consideration as we progress to a decarbonised future, how we make sure that that's also affordable for all consumers.
Rob, excellent points. So you were emphasizing the challenge of the long-term goal 2035 of a decarbonized grid with the short-term troubles that consumers are facing. So let's talk a bit more about timing, if we could. What should be the rollout for the market redesign reforms?
Well, I think it's a very good question, and I guess because a lot of the kind of the options that we're considering for the review of electricity market arrangements, obviously there are some which represent kind of more incremental reforms to current systems. You know, for example, changing the CFD somewhat or reforming this capacity market somewhat are relatively straightforward reforms which could potentially you know, be rolled out in the next few years. Obviously, some more kind of transformative arrangements, so, you know, kind of setting up a fully split market has, you know, deliverability considerations, which would mean it would necessarily be a kind of a longer term process. Similarly, in terms of locational pricing, obviously the lack of locational signals is something that we've kind of really identified as an area for reform. There are more kind of subtle ways to do that. There are obviously more kind of transformative ways to do that, such as nodal or zonal pricing, which would, you know, take several years to implement. And obviously we're kind of very aware of the fact that we both need to consider, you know, some of these kind of short-term factors, but also the more kind of medium term when thinking about these kind of more transformative options, which, you know, may potentially take several years to implement.
Would anybody else like to add to the issue on the ideal timing of the reforms?
I appreciate the difficulty of the task that they have got. What I would love to see from them is making some of the big decisions up front, and then allowing predominantly the industry to work out through the detail, because you can spend decades working out the details of how you do market splitting or another market design and never really get to a point of consensus. I think you can get the big decisions done quickly. It'll be lovely to see some of that done this year, ideally, and then work out the details. I think it also links to a more general point on how we do energy policy and market reform. There is a tendency to sort of every 10 years or so reopen everything and look at everything afresh and sort of look for the big bang. And I just don't think that's going to work in a sort of continuous transition to 2050 and probably beyond. What we need is a much more adaptive approach to policy making. So making some big decisions and then building in gradual learning as we go and reforming and recognizing that that's part of how things are done. The concern always with something like adaptive policy making is the impact on investment confidence of investors. But I think if you retain all the sort of well-established principles for good policy making around clear articulation of why you're looking at things, transparency around timing, consultative processes, evidence-based decisions, all of that can be built into a more agile, adaptive timeframe rather than trying to sort of rip everything up every 10 years and then taking 3-4 years to implement the latest thinking.
I agree with Ben's point that the transparency in this process is going to be absolutely vital. Concerns over how long the process could take have certainly influenced our conclusions that are continuing with marginal pricing design and altering mechanisms around it rather than any significant shift is perhaps best with the 2035 decarbonisation goal in mind, and the risk that rolling out a new pricing structure now does risk creating high levels of revenue uncertainty for investors, and sort of could therefore sort of delay investment coming forward until clarity is achieved on price formation under a new structure. But yeah, we look forward to the follow-up responses and firmer proposals from BEIS later in the year.
Thank you. We have a few specific that I think, Sam, it would be great for you to address itself, but then they lead to a much bigger question, and I'm also very curious about that one. So the specific question is regarding one of the slides where we could see some coal in the 2035 and the end period. Is that really the case? Are you really modeling some coal in the late years? And that ties very much to a broader, bigger question that I would love to hear the whole panel talk about. Have you considered, and are you accounting for storage in the analysis? And there are some additional questions that tie to that. Hydrogen, green hydrogen. What about the what would have been curtailed electricity, and using that to split the water molecule and therefore have the green hydrogen stored for that use in the peaking hours? So we started with a very specific question and then get into a much bigger discussion around storage.
Sure, no problem. And so just dealing with the first question first. So I think the question is about this small black segment at the end of the 2025 example. It's actually not coal. I simplified the legend just for the purpose of this presentation. This is actually an open cycle gas turbine plant, which is peaking during the highest level of demand in the day. So coal in our scenario is phased out by the end of 2024, and even next year there's very small amounts of residual coal generation. So, but moving on to the question about essentially flexibility providers and batteries and hydrogen. In this first iteration of the model, we focus primarily on just how the in-market revenues for generators were different in the wholesale market under the two trading arrangements on the basis of technologies that are readily available today. And so we limited the scope initially to try and ensure that we were making an apples and apples comparison between the two market designs. And so for the purposes of this iteration of the model, we assumed that storage would potentially be shorter duration and therefore have more activity in the balancing markets. And it's possible that, and probably likely in fact, that further down the line, long duration storage and hydrogen electrolyzers will in fact be quite active in trading in the day ahead wholesale market. And we have been expanding the model to incorporate this. Preliminary results indicate that essentially the effect of having these sort of flexibility providers active in the wholesale market would be to reduce some of the more significant intraday volatility that you'll see under marginal pricing, such as in the 2025 example on the right hand side. And this is because the incentive for them will be to enter the market during periods where there's a supply glut, let's say the early parts of the 2035 example. This then increases demand and bids the price up, which it would also address the possible risks of price cannibalization, but then there'd also be a reserve of power storage, which could be sold back into the wholesale market during the periods of scarcity pricing in the later periods of the day when renewable generation drops off. And so we hope to come out with a subsequent publication going into the impacts of flexibility at a later date.
Thank you, Sam. Would anybody like to comment on storage and impact of of clean energy storage in these pricing signals?
I maybe follow up from Sam's point. I mean, it's clear that supporting low carbon flexibility assets and providers and ensuring the price signals needed to run those efficiently is going to be a vital element of a renewables dominant power system, and the absence of those pricing signals for flexibility assets really under a split market design where a market floor price would almost be set of renewables levelized cost of energy is a key design flaw. A carbon-free power market needs to provide incentives for the clean technologies that are struggling currently to be profitable. So battery storage owners and demand-side response-focused firms, and those will support system stability over the longer term, while electrolyzers need to be able to take advantage of those low price periods to produce green hydrogen for use on cold winter days. So intraday price volatility remains important and provides strong price signals for key sections of the market. We just need to deliver a balance between maintaining that but ensuring long-term price stability for consumers. And so ensuring the market is sufficiently suited for flexibility providers is really going to be a vital element in phasing out gas plants that currently provide those flexibility services, and therefore making eventual decarbonisation of the system actually achievable.
Maybe to add, when we're discussing, let's say, all these technical flexibility options, I think one also important element somehow outside of the market is actually the grid. I mean, of course, it's not neither politically feasible nor economically sensible to expand the grid up to infinity, of course, but it's still an important enabler of flexibility and renewables integration. I mean, we probably will discuss maybe in a bit more detail the issue of locational pricing, also because of course domestic grid constraints, but also what I want to allude to, the cross-border system integration. So interconnectors also, when we look at, for example, wind speeds and wind feed-in, it's actually quite surprising how decorrelated wind feed-in among neighboring countries is. So one can really benefit a lot from building interconnectors, maximizing security of supply while minimizing system cost. And at the same time, that also then is another link to market design, how in the market clearing process is this interconnection being utilized. And there I think also all countries throughout Europe can benefit from specifically further refining intraday markets across borders, using more auctions to really make the most of the physical infrastructure we have, and to maximize in the short term the renewables integration.
Yeah, that's a great point on the integration of the different grids. There's a very thought-provoking question. The Labour Party have pledged to bring the power sector decarbonization target forward to 2030. Would your conclusions and your views on the best way forward change in case of a 2030 target?
So it's a little bit difficult to say on the fly without doing additional analysis. My suspicions would be that essentially the spread between the split price and the marginal price would expand just on a more quickly than it would if the 2035 if the decarbonisation timelines are 2035. But again, it's difficult to say without doing more analysis.
I think it's worth saying here that obviously market reform is only one piece of the puzzle here. You know, Christian mentioned the importance of the grid in supporting a decarbonised system, and that gets you into all sorts of questions around planning permission and upskilling of the workforce. The reality is that the sort of capacity that's required to be built to decarbonise the British energy system, or electricity system, I should say, by whichever time frame, is enormous across renewables capacity, flexibility, and the enabling grid infrastructure. And most of those things take multiple years to build. So there's a legitimate question to be asked of whether a government coming in a couple of years' time would actually have the time to deliver that level of investment by 2030. I mean, I think even 2035 seems quite difficult to achieve. I'm optimistic about our ability to sort of innovate and challenge and deliver, but I think 2035 looks incredibly challenging. 2030 looks, in some extent, like we've probably already missed the boat on that, to be honest.
I suppose just to come in, that obviously, I've said we're taking a very holistic approach through the review of electricity market arrangements in terms of looking at markets for lots of different technologies, looking kind of in concert with retail markets, with flexibility markets, etc. But obviously, yeah, it's not the entire picture. The grid is obviously a critical enabler of increasing renewables and kind of passing on those benefits to consumers. Obviously for those viewers less aware, in the UK you have a lot of kind of electricity generation in Scotland that is far away from kind of the demand centres. You need kind of huge amounts of transmission capabilities to get it there. We've made kind of various commitments to rapidly accelerate the build out of transmission infrastructure, both onshore and also through the offshore transmission network review. Offshore, where there's going to be a more coordinated approach to offshore network infrastructure to ensure that it's getting to shore and getting to consumers in the most efficient way. And also, yeah, we completely agree in terms of the benefits of integration with our neighbours. There's been quite an expansion of interconnection capacity in Great Britain over the last few years. The opening of new interconnectors to France and Norway, and that's kind of expected to continue over the coming years to provide that important source of flexibility for when there are those differences in renewable generation between other countries, where we can utilize that flexibility to ensure the most efficient usage of the renewables is made.
Thank you. An interesting question here. Research has shown that 90% of generation will be on contract for difference by 2035. Are you comfortable with this level of centralization, and how would generators be supported at the end of their 15-year contract for different terms?
So we would be open to discussion with BEIS as to how CFD contracts lengths are decided over the long term, and whether sort of this would be tied into a sort of restructuring of them based on this cap and floor mechanism we put forward. We did consider that, given under marginal pricing, the extent of payouts for CFDs over time would obviously be quite substantial. But we compared that back to the market split and estimated that roughly the payouts would sort of still be equal to the extra cost that would be incurred under a market split. I mean, I think the advantage of the CFD compared with the market split at the moment in its current form is that the contract does have sort of 15-year length and sort of doesn't lock the consumer into funding those long-term payouts. But I think, given the risk of price cannibalization, probably need to sort of review that over time, and perhaps sort of Rob could comment on whether that's part of the ongoing review into the structure.
Yeah, I mean, absolutely. I think it's kind of something we've identified, that with expected increases in very low prices in the future, with price cannibalization potentially limiting revenue for generators from the wholesale market, there is that investment risk of projects being able to kind of justify their they're building through purely the wholesale market. And so absolutely, in terms of aspects such as, you know, CFDs and cap and floors, etc., what is a consideration is what is the most appropriate contract life, how would that kind of work, for example, for repowered projects. So there's a recent consultation in terms of the CFD and kind of, I guess, more the kind of the short to medium term about the possibility of repowered projects taking part in the CFD. And so those are all kind of important things we need to take into account to ensure that, you know, not only are investors confident enough for the renewables to get built, but they, you know, can kind of participate after the end of that kind of initial period.
We're talking from that point of view of investors, but then again, there's the point of view of the consumers. One of the questions relates to that. From a consumer standpoint, if you split the market, what would keep a downward pressure on the cost of the dispatchable market? And wouldn't the splitting of the market simply be a risk transfer away from renewable investors to the consumers?
Sam, are you happy to sort of take that one on the basis of the modelling?
Yeah. So if you split the market, remember we said that the dispatchable segment would be priced in the same way as the entire market is priced today. So on the basis of the variable costs of the marginal fuel. And so in that segment of the market, the largest variable affecting the price is the cost of gas up until around the end of 2030. Assuming that gas is the marginal fuel. And then after that, because we assume a moderation in gas prices, but an increase in carbon prices, the carbon price from the marginal generator becomes the largest component of the marginal price. But as for being a risk transfer away from renewable investors to consumers, I mean, given that we discussed before that there are other out of market revenues such as the CFD scheme, but also participation in capacity markets and, you know, ancillary service balancing markets. I don't see why there would be a risk transfer from one segment of the market to the other necessarily under marginal pricing.
Okay, we will have to wrap up in about 5 to 6 minutes. Some of our panelists have previous engagements. This may or may not be the last question. Let's see. And it's one on locational pricing, the pros and cons and the likely impact on the market of that locational pricing. Rob, you were talking a little bit about that. Should we start with your views?
Yeah, absolutely. So I think similar to on the kind of the marginal pricing side, where in our initial consultation we laid out a kind of a range of options from, you know, the less transformative to the more transformative of a green power pool or a split market. Obviously, on the locational side, there are a wide variety of options ranging from, you know, less transformative, maintaining national pricing, to moving to zonal or nodal pricing. Obviously, there are advantages to those, you know, in terms of kind of passing on the kind of the true kind of pricing of power in those particular markets, benefits potentially for flexibility, but obviously there might be kind of drawbacks in terms of the confidence that investors might have in their revenue. And then, you know, obviously you've got to take into account those implementation challenges that I mentioned of the more transformative changes, and that's something we're kind of doing at the moment to really kind of work out what might be the best option to actually get those locational signals, bearing in mind that obviously, you know, there are some you know, flexibility providers, etc., that can adequately respond to those locational signals, but also you know, for some kind of generators, for example, offshore wind farms, etc., obviously the degree of kind of price responsivity might be a bit more limited. Also, probably to add that you know, even if a kind of a system of national pricing is maintained, there are also kind of other ways that we've included in our consultation to pass on more locational signals. So obviously we've been talking a lot about CFDs, whether you kind of bring locational aspects into CFDs or the capacity market for those locational signals, or through systems like the transmission charging that we have at the moment, whether that can kind of better reflect locational signals. And so it's obviously quite a complex picture of deciding kind of what might be the best option. I suppose it's a picture where there's maybe more kind of international comparisons. So this kind of extreme split market, which this report is a subject of, is not something which has been done elsewhere. So the implementation and kind of any unforeseen consequences might be kind of quite hard to really be fully aware of. Whereas obviously there are other markets in Europe, Norway or Italy, where they are in different zones for a particular country, and then in, for example, the US, different markets with nodal pricing, and so I guess that's maybe a difference to draw out compared to that question on the marginal pricing side. But interested in any others' views on the locational pricing side as well.
So yeah, I mean, I echo Rob's points, but we see a lot of benefits to locational pricing, particularly in Britain. Whereas Rob said we have a serious imbalance in the sizing of a significant chunk of our low carbon supplies, and the distance away from key demand centres, and shift to locational pricing of some form would send out much improved pricing signals to investors as to the regions that are most in need of infrastructure investment. The concerns we flag in the report around this design, however, centre around the risk that a more fragmented market would result in a further slowdown in wholesale market trading liquidity, which is already at pretty thin levels, and the risk that this could restrict firms' ability to hedge their long-term exposure to market prices and the degree of price volatility that could cause. We also think that sort of again a shift to such a radical change in design from the status quo could create that sort of temporary revenue uncertainty for investors, at least in the short term, until sort of clarity on regional prices is achieved. But that said, we wouldn't be against this model being opted for if policymakers can navigate those challenges associated with it, and we do see a lot of benefits to locational pricing, which have been proven elsewhere in the world, and actually, sort of as Rob said, bringing elements of this into the CFD scheme could certainly be interesting to look at. I would just say finally that whatever market design is opted for, improving Britain's transmission system infrastructure needs to be prioritised to ensure that we are able to efficiently move power around the country, and then instances like the one we've just seen earlier this week, in which our wind power was being curtailed, but the UK still acting as a net importer across the interconnectors with Europe at the same time because of the inadequate transmission links in place across the England-Scotland border.
Thank you very much, Jonathan. We have 1 minute left. I would like to take this opportunity to emphasize that if there are additional questions that you would like to share with the panelists, please do so. All the presentation and of course the report are available on the website. You can find that at Carbon Tracker's website. And I take advantage of this opportunity to thank Carbon Tracker for the amazing work that you do, and for this opportunity to be here. I learned a lot from all of you today. Thank you very much for having me, and thank you, audience, for dialing in. We had a pretty, almost 100 people at any given time, so thank you for that.
Thank you very much.
Thanks, Gabriel. Thanks for joining.
Thank you.
Thank you.